Hello, I'm Nikki Newton, President of UMB Private Wealth. It is my pleasure to welcome you to the 2024 UMB Economic Outlook. Before we take a look ahead, I'd like to thank all UMB clients for your continued collaboration. Over the past year, I've had the opportunity to speak with many of you, and in those conversations, I've seen a recurring theme. Our relationships are built to last. For over 110 years, UMB clients have been at the heart of everything we do. Your vision and dedication to your financial goals and legacy motivate us to deliver our absolute best, providing you with clarity and confidence every year. Today, I have the privilege of introducing our speakers. First, longtime UMB leader and newly appointed Chief Investment Officer, Eric Kelly. Eric served UMB clients for more than 25 years. As CIO, Eric oversees our private wealth management, investment, and portfolio construction teams. And joining him is our Director of Asset Allocation, Dan Kiefer. Dan applies his extensive financial expertise to develop and deploy our private investment and centralized investment management offerings. Eric, Dan, and their teams skillfully analyze the financial landscape that impacts us all. Their insights help nurture our client relationships with confidence and stability through every economic current. And with that, I'll turn it over to our speakers.
Hello, welcome to UMB's 2024 Economic and Market Outlook, which we are calling Crosscurrents Ahead. I am Eric Kelly, the Chief Investment Officer for UMB, and with me today is Dan Kiefer, who is our Director of Asset Allocation. Welcome, Dan.
Thanks, Eric.
We are here today to try to clarify for you where we think things are headed in 2024, and I will start by unpacking what we mean by crosscurrents ahead and this image that you see in front of you right now. A cross sea is caused by two different sets of waves or cross currents that are converging at different angles. And it creates this interesting pattern on the ocean that you see here, which are called square waves or cross waves. And it's kind of a pretty, almost peaceful looking scene on the surface of the ocean. However, cross waves or square waves caused by cross currents can take even very large boats dramatically off of their chosen course. And navigating through cross currents or cross waves is a very precarious undertaking. We think it's a great metaphor for where we are right now in the United States with our economy. We're facing numerous cross currents as we head into 2024, the prospect of a soft landing, the possibility of a recession. We have geopolitical issues. We have an election coming our way. These are all cross currents that we have to deal with. We're going to unpack each one of those issues and let you know where we think they're going to land in 2024. And most importantly, what does it mean for the financial markets and for the portfolios that we manage for you? And we're going to start by unpacking this first topic. The first cross current is the possibility of a soft landing. And in recent weeks, Dan, the soft landing thesis has really taken fire at the end of 2023. Huge rallies in the markets because people started to shift in the soft landing direction. But hopefully you can unpack for everyone what really is the definition of a soft landing, or the traditional definition, and some of the data that's actually pointing in that direction, at least at this point in time.
Sure, thanks, Eric. You know, a soft landing is traditionally thought of as a softening of economic pressures from inflation and, as a result, the Federal Reserve interest rates without a recession associated with it. We've really only had one time, as an example, back in the mid-90s, where the Fed was able to come off interest rates and we did not see an associated uptick in unemployment or a recession associated. And that's really what the data shows that we might be experiencing here, where we have inflation declining, at least by one measure, pretty substantially. We're not all the way to the Fed target, but we're certainly getting close. And unemployment has not substantially ticked up. So we could very well navigate this without a recession. However, depending upon how you define inflation, it might not be coming down as quickly as it might look on the surface.
Yeah, and this is a super difficult thing to orchestrate for any central bank. It's probably not the most likely outcome that we're predicting right now. And one of the biggest problems we talk about at the office right now is as the 2024 forecasts come out, it's apparent that there's some cross currents even in what the definition of a soft landing is.
Sure.
We've known there was some disagreement about what a recession is in current times, but recently it's become quite clear we're not exactly sure what folks mean by a soft landing, and we're going to illustrate why we're saying that. This is one of the major forecasts that came out just last week. A large forecasting firm, very well respected, published this. The first set of quotes: soft landing is achievable, inflation's on track, slower growth and softer labor are coming, but we will stop short of a recession. We do not expect the slowdown to tip into recessionary territory. Understood. That's kind of a classic definition of a soft landing. But literally on the very next page, they had this following table of data that showed this was their GDP forecast. Back-to-back quarters, Q1 and Q2, negative 1% GDP. Elsewhere in the report, they showed that unemployment was rising. Well, unemployment rising and GDP in negative territory is a classic definition of a recession. So this would be a mild recession, but in this environment, some firms are calling this type of data a soft landing. So it's a little cloudy about what people mean when they say soft landing. We would agree with something like this outcome, negative GDP, which we'll talk about later, and rising unemployment, but we would call that a mild recession. So we think that's what is headed our way. We'll see what the academics say as 2024 unfolds, and they argue what the semantic terms are. There's going to be some debate about those things, but we'll push on and talk about the economy itself, center stage. What is going to happen to the economy in the United States over the coming 4 or 5 quarters? On this chart, you have GDP growth rates for the last 2 years. These are the quarterly growth rates on an annualized basis, which is how they get reported. And what has happened is on the left in the dark blue bars, that's the actual published GDP growth rates. On the right-hand side, we have the light gray bars, our estimates of what's going to happen. And as we've talked about, we're coming off a very robust growth number for the last published number we had for the third quarter. You see there where it says September of 2023. We had an almost 5% GDP growth rate. And that is clearly an unsustainable number. You see across the middle where it says 2% and it says natural growth rate. That's because our economy has a natural growth rate of roughly 2%. In the third quarter of this year, we grew at more than double our natural growth rate. The economy must slow down from there. It was fueled by a lot of different things. It was mostly household consumption of goods and services, maybe fueled by some of those leftover stimulus dollars, which we'll talk about in a little bit. But everyone in the world agrees it's going to slow down. And on the right-hand side, you can see what we think is going to happen. We think it's going to fall to below average for the fourth quarter of this year and on into next year, below 2%, probably in the 1% range, and headed lower. And most importantly, second and third quarter of next year is our best estimate for when we think we'll actually have negative GDP, which we would call a mini recession, because we do believe that unemployment will be rising. For us, that's not a soft landing, that's a mini recession. This is not a catastrophic forecast. It's going to be a slower year in 2024 than we had in 2023. On aggregate, the year should come in around a 1% growth rate. So we will still have positive growth rates for the year. We should still have positive earnings growth, which we'll talk about later, so we could have a reasonable stock market outlook. But for sure, it will be slower than the year we just came out of. And Dan, we really know we should probably expect something like this because history tells us we typically do have something like a recession after a major Fed tightening cycle, which is what we just came out of.
Sure. I mean, perhaps counterintuitively, we had a really strong economy coming out of the pandemic, and as a result, we have a really strong response from the Federal Reserve. As you can see in relationship to prior Fed tightening cycles, this is the strongest or the steepest that we've ever experienced. As a result, it's hard to see how a historic tightening in monetary policy does not end up leading you to a recession.
At least a mild one. And we know, we've talked about a lot, these things work with a lag, and the Fed has told us that it's about 18 months. From any tightening, 100 basis point tightening, takes about 18 months for it to impact the economy. That means 2024, these last couple hundred basis points are just going to be biting into our economy. And so for us, cautious, right?
Yes, very cautious.
Have to remain cautious. This story is really all about inflation, as Dan talked about. The stimulus unleashed a wall of inflation that the Fed is dealing with. So we have to talk about the behavior of inflation and then leading into what the Fed may or may not do about it. The story on inflation is, again, filled with cross currents. Some of the major inflation measurements, there's many of them, some of the big ones are indeed rolling over and coming down relatively quickly. And Dan, why don't you walk us through that, because that's the first part of the soft landing story, but it's not as easy as it seems.
Sure. I mean, when you look at headline CPI or sort of headline inflation, it definitely is slowing. The rate of advance is slowing. However, we're still a little bit away from the Fed target, but this is certainly a reflection of the monetary policy starting to kick in. Depending upon how you measure inflation, it may or may not be coming in as quickly as you might like to see.
Yeah, we're away from the Fed target still, even on these ones that are dropping quickly. And behind the scenes there, the Fed has other variables that they really like to follow. They don't tend to follow these broad ones. They follow a thing called supercore inflation. This is Jay Powell's favorite version this time out. He tells us this is what he's following very, very closely. And they peel out a lot of things. Food and energy come out. They take out goods and they look at services only. And they also peel out housing. He thinks it's really important to look at this particular measure of inflation. And as you can see on this chart, it's coming down, but it's not coming down nearly as quickly as the broad measures of inflation. It crested up above 5. It's worked its way down to 4, but it's meandering quite slowly lower, probably not as fast as the soft landing folks would like to see. You can see the Fed target down below there, 2 to 2.5. The challenge we have right now is the Fed's favorite measure of inflation, what we see here, the pace that it's on, at this pace, it would not get down to the Fed target zone for almost 18 months. That would be well into 2025. So in order for the soft landing thesis to probably play out, this needs to drop quicker in 2024. It may or may not, but inflation is a little sticky, and in particular, this version is heavily reliant on wages. This is services inflation. Services inflation is driven by wages, and the story of wages is really the story of the jobs market. And we've had an incredible jobs market for a couple of years. It's been unbelievably tight. That's one of the things driving inflation. We want to look at the current status and where we think where it's headed. So Dan, why don't you take us to probably the most important thing when we start this topic is the unemployment rate and what it's been telling us.
So the positive thing is that we've had the best unemployment rate in the last 40 years, right? So there are a lot of people at work, and that makes it tight for employers to be able to find workers. The downside to that is, of course, that there's more money in the system chasing fewer goods or the same goods, which results in inflation, right? So in order for the Fed to be able to declare victory, so to speak, in a soft landing, they need to be able to keep unemployment the same with a declining interest or declining inflation, which is sort of counterintuitive. You can't have people making above average wages and not see the prices of things increase. So unfortunately, that probably means we see the unemployment rate start to drift up towards that natural rate of unemployment of, call it 4.5, meaning that this time of historic tight labor markets is likely going to come to an end.
And it's weird. It's hard for us to say, yay, more unemployment, but for this thing to work itself out, we need the unemployment rate to increase up towards...
so slightly and calmly, yep.
Yep, up to that normal 4.2 level at least, if this inflation thing is going to be solved. The unemployment rate is saying that's not happening right now. The job market is incredibly tight, but we like to look at the leading indicators for unemployment. There's a lot of them, and most of them are sloped in exactly the same way, and they're painting a picture that tells us this thing could be curing itself, meaning unemployment is probably going to start rising, hopefully slowly. There's a lot of different variables we could look at. This is a really good one. It's an aggregate of 3 primary variables. It's payrolls and hours worked and wages all rolled together. You peel them apart, all 3 of those charts look the same. This is the aggregate of those, and it's clearly tapering off. The aggregate weekly payroll index, very, very high when unemployment was dropping and the jobs market was extremely tight. Unemployment hasn't changed yet, but this index tells us it probably is going to creep slowly higher because the payroll index has almost completely normalized. It's not back to its normal level that we had during the last decade, but it's just above it. But that tells us the jobs market is cooling, and it should help push unemployment up and get the inflation story going more favorably for the Fed as we move into next year. Again, this ties directly into wages and consumption. That's household finances is also driving this whole consumption story. So we want to take a quick look at household finances because that is what drives consumption in the United States, and we're a 70% consumption-based economy. And one of those themes we touched on was the incredible impact of the excess dollars from stimulus, from the COVID stimulus. They distributed trillions of dollars into our economy. It turned out that a few trillion of those were not really necessary, and they ended up in checking accounts. And that's what drove this chart that you see right here. This is excess savings in household accounts over and above the normal savings rate that was in place before COVID, and something like $2 trillion. There are other estimates that are quite a bit higher. Some say 2.5 to 3. This is a conservative estimate. At least $2 trillion of excess savings ended up in household checking accounts after COVID. That's what drove much of the consumption we've seen in the last 2 years. That's what drove the inflation rate higher, but it is burning off. Many folks think that the big GDP growth we had in the third quarter that I talked about of this year was the last gasp of the extinguishing of these household savings. On the right-hand side of the chart, you can see the very best estimates we have is that there's probably still about $500 billion of excess savings in household accounts, but most of the folks who follow this closely think it is tapering off. The dotted line shows you most folks expect by the end of the first quarter of next year, the excess savings miracle from COVID will have been burned completely off. That'll slow down consumption. It'll be a drag on the economy. It's one of those things that'll produce those low GDP rates we were talking about, but it will also help cool off inflation. So it's cross currents. It'll be helpful in some ways. It could cause a recession in other ways. So it's one of those things we're following very, very closely. That pulls right into the next subject, which is consumption also comes from the path of wage growth. Wages in the United States, just like the jobs market, when the jobs market tightened up, wage growth spiked up to more than 8% annualized. That's a huge wage growth number for the United States. It's been coming down. It's been coming down quite nicely. This is average hourly earnings, and it is on a downward trajectory. That tells us that wages aren't shrinking. This isn't lower and lower wages for the average household. The growth rate is shrinking. Wages are still growing, but at a much lower rate, closer to normal. So the drop-off in wage growth pressure is another thing that will lower consumption. It'll slow down the economy, and it will help solve the inflation problem as we move into 2024. It's not just a story of wages either, because credit is also a very important variable in consumption. And Dan, that story has changed quite a bit lately too.
Sure. I mean, historically, we've seen credit be the replacement for wage growth or wages in general. Here we see that not only are you facing higher interest rates, but you're also facing a much tighter credit environment. So banks are not lending the way that they had earlier in the cycle, and as a result, it makes credit harder to access. The issue, though, or the good part of that, or the other side of this, is that even if we do see these things come to fruition and create a recession, the financial position of individuals as well as corporations is much better than we've seen in previous recessionary cycles. If you look at household debt to GDP, or how much of the economy is represented by outstanding debt on household balance sheets, it's the lowest we've seen in 30 years. Similarly, with the financial obligation ratio, meaning how much does it cost to service debt as a proportion of disposable income, again, very low. So this is promising from the perspective that if we do go into a recession, it's not going to be deep.
Yeah, and this area in particular, household finance, a lot of cross currents here. It's a great job market, still very tight, but cooling. Wage growth has been fantastic, but cooling, right? All these things. But the average household balance sheet is very, very, very strong. So that's why we would say we think a lot of these things may result in a mini recession, but this story right here is the reason why we think it'll be mild. Households are in great shape going into this slowdown that we think we're running into. And another important part of the story, which is just an important thesis in the United States, is the housing market. It's not a huge driver of the economy anymore, but it's a huge driver of sentiment. And the goings-on inside the housing market are very interesting right now, too. So why don't you cover those?
Yeah, I mean, it's a very straightforward story. Interest rates are a lot higher than they used to be, so mortgage rates have a 7 or 8 handle in the last quarter here, as opposed to a 3 handle, which is the vast majority of outstanding mortgages today.
Dramatic change.
Prices have not changed substantially, at least in part because people aren't interested in selling. So there's not a ton of supply, so what supply is there is being met with strong pricing, meaning that affordability is at nearly a record low. So this is detrimental for household formation, those that are trying to get out of an apartment and into a home, but it's not by any means a forebearer of catastrophe ahead.
Yeah, it's not a direct, meaningful impact on the economy, but it drags down sentiment, drags down psychology, and it's the kind of thing that can impact it in sort of a secondary way. Certainly everyone is aware of that problem in the housing market. A couple other cross currents we have to deal with coming our way quickly. 2024 is an election year. We know that it could be a very choppy ride in this election. Polarization in the United States is at an all-time high by a wide margin. This is a great graph of polarization here in the U.S. By the way, polarization charts for the rest of the developed world look exactly the same. We live in a very polarized world. So we know the election this year is going to be probably very spicy, highly emotional, and could have very severe psychological impacts for most of us Americans that pay attention to it. However, there's an important thesis here. It's a strong cross-current on sentiment, but elections in the United States, the data suggests that they tend to not have a meaningful impact on the economy and the markets. The specific election outcomes don't tend to be actionable things for us to change investment strategies around. Some folks don't like to hear that because elections and politics get them very, very upset about things, but it's actually the good news is we don't see any reason that we should take a particular strategy or tactical move based on the pending outcome of an election. It simply isn't wise, and the data support that we just stay steady through that. And that's what we plan to do in 2024. A similar vein, we have a geopolitical landscape. Unfortunately for the world, we just had a new geopolitical conflict that erupted just in the last couple of months. That means we're living in a world now where we have two hot conflicts in Israel and in the Ukraine, and we have a potential one that is getting more and more headlines between China and Taiwan. And the news here and the story here is similar to the one on elections. Despite how strong they make us feel, despite how awful they are from a human perspective, despite how damaging they are from a psychological and emotional perspective, those things are real. Geopolitical conflict, if it stays contained to a specific region, tends to not have a major impact on the global economy. And therefore, once again, tends to not be something that are things that are actionable for us from an investment perspective. That can be an upsetting thing to hear for some folks because these things do upset us emotionally. They upset us psychologically. They're terrible things, but usually they are not actionable from an investment perspective. We do believe that that's the most likely outcome for 2024. A couple of these events could spill over and become meaningful global events, but we think that is a less than 50% likelihood. So for 2024, we think that we are going to probably stay the course and not need to take any action around these awful geopolitical conflicts that are coming our way. You got to summarize all these things, all these cross currents that we've covered, pointing in a lot of different directions. What do they mean? What does all this mean for your portfolio and what we're going to do with your investments in 2024? This is Dan's bailiwick right here. Dan, what does it mean for asset allocation? What does it mean for investment strategy?
The most important thing that it means is to revisit your risk posture or through your financial plan, because with substantial cross currents and potential negative outcomes as a result, you need to be able to weather those storms. And so making sure that your house, so to speak, is strong enough to deal with the impending storm is the most important thing you can do. From a tactical perspective, it's more, we're not taking excess risk. We're looking for opportunities. However, we think that the range of outcomes is so wide that it's very difficult to make a reasonable bet, so to speak, when thinking about tactical opportunities. From a strategic standpoint, you know, the reshoring of manufacturing to the United States, the general reconsolidation of a manufacturing base here does make us more likely to have a larger base of financial assets in the United States and away from, say, emerging markets and international markets. And so that's likely something that you'll see is a decline in international assets as a result of lots of conflict stirring. But that's not so much because of the conflict, but because of the trend of reshoring of financial and economic activity locally. The biggest thing, probably in a response to an uncertain environment, is to take a longer term view. And so we think using private markets, whether that be private equity or private debt, is a very appropriate approach to dealing with short-term uncertainty because it removes the impulse to trade securities, and private markets, specifically private equity, have a much longer time horizon, which should align with your financial goals.
So the bottom line on this, in the simplest terms, make absolutely sure you met with your planning team to make sure that you have the right investment objective in place and the right risk tolerance identified. We're mostly neutral going into this year because it's going to be so choppy. We're looking for opportunities. If they arise, we think they will arise, and we probably will move into risk assets at some point. And along the way, consider private investing, because private investing kind of keeps you out of some of this short-term turbulence. You're thinking of very long-term, right? And that's a long-term solid play.
Not only does it align with a longer time horizon, it also provides a tailwind of excess returns, and there's not an opportunity to tactically time a long-term purchase.
The private markets, sure. We will hit real quickly the financial markets, stocks and bonds, tell you where they are now, what we think is going to happen next year, starting with, of course, the stock market. It's been an amazing year in the United States in the stock market. We've had phenomenal returns, well north of 20%. Cross-current here has been an interesting story because we have this whole Mag 7 story. The Magnificent Seven have dominated the markets. Most people are being bombarded with that story. What do we think that means? Does it mean anything?
Yeah, so this is a tale of two allocations, right? You had 7 companies that are up, 70, 80%, depending upon the timing of your measurement. And those are all related to effectively AI plays. It's an AI theme that is expressed through the Magnificent Seven. The rest of the market, if you take those 7 out, is up 10%, which is a great year, but it's not a banner year. We think that historically, or the data show that when you have this level of concentration, it does not foretell a sharp decline to come. Mostly it means that likely the 7 that have done so well, or the concentration that's done so well, tends to lag and the rest of the market catches up.
So it's not some folks are reading that this is a harbinger of doom, that the leadership is very, very narrow, so that has to be a bad story. We don't think it's automatically a bad story. It's been a narrow market, but we're still confident that next year can be okay.
Right. So so long as the market broadens out, and so the Wall Street thinks that we're going to have a 12% year-over-year increase in earnings. We think that's probably optimistic. We'd put earnings probably at 6%, but as long as we don't have a substantial change in valuation, which is generally driven by interest rates, we're going to have a very average year. Call it 6 to 9% year-over-year growth.
Yeah, below the Wall Street estimates, but still a decent year next year is what we're expecting on equities. It takes us to the fixed income markets. It's been, again, in 2023, a really good year. The drop in rates we saw at the end of the year gave us nice positive returns. But what's going to happen next year for fixed income investors in terms of total return? Well, we think it'll still be a good year. The story will really be what happens to longer-term rates. We believe the Fed will be easing on the short end, but will long rates really fall? And we think that they will fall, but we don't think they're going to fall very far. They've fallen a lot just in the last 30 to 45 days of 2023. And we think there's still going to be some inflation in the system. So the Fed will probably land in a place that will mean the long end of the curve, the 10-year Treasury note rate, probably will only drop to about 375 in 2024. That's not very far below where it is right now. So it could be a very slow, gradual move to lower rates on the long end. That's not bad news. Fixed income investors are going to start the year with a 4.5% or 5 or 5.5% yield on their fixed income holdings. And if rates fall a little bit, they'll get a little bit of a boost from that. So we could have 5 or 5.5 or 6% returns even in the fixed income markets next year. So in aggregate, it could be a good year for financial assets next year. We will sum up our presentation today by summarizing the year ahead with a little table. We want to do this as realistically as we can. Forecasting is an incredibly difficult business, and we want to have enough humility to say, this is our best guesses, this is our base case scenario for what we think is going to happen. But given all the cross currents, the risk to these forecasts is very, very high. But we think this is the most likely outcome for the variables we've talked about today. We've already highlighted most of this. Real GDP slowing from 2023 to 2024. We had a good year in 2023, probably slowing to around 1% or a little bit lower next year. Below average, but okay. Inflation falling, probably in a fairly erratic manner, but from the mid threes where it is now to the high twos by the end of the year next year, not to the Fed target, but at least directionally going to a zone that makes the Fed happy to start easing. The unemployment rate, we think, rising, as we talked about, and Dan was very specific about. 3.5 to 3.7 is way too low. The unemployment rate needs to rise going into next year in order for all these other parts to fit together. It should be rising up to the mid fours, maybe slightly above the normal rate there. That will inspire the Fed to start cutting rates probably. That's the next line of the forecast. We're starting the year at 5.5. We think they'll be cutting, not aggressively, but probably 100 basis points down to around that 4.5% range by the end of the year next year. That'll enable the S&P 500. All these things above here will enable the stock market to generate 6% earnings growth, as Dan talked about. And in that environment, with the Fed easing towards the end of the year, even with a mini recession, even with the election and all the cross currents we're going to encounter, stock market still should be able to generate, we would say, 6 to 9% returns next year. So in aggregate, a decent year for investment portfolios, a decent year for investors. We're going to stay the course and look for opportunities as next year unfolds. On behalf of the UMB Private Wealth team, thank you for joining us today. If you're a UMB client and have questions about anything we covered today, please reach out to your UMB team. If you're thinking about joining the UMB family, thank you for tuning in. And please feel free to schedule an appointment to talk to us at umb.com/privatewealth. As always, we're here to help you navigate any cross currents headed our way with clarity and confidence.